Welcome to Breaking News to Trading Moves. Today we're looking at how a single political development can, well, almost instantly cause some very real movement in the markets. The headline here is President Trump's recent actions related to Venezuela's leadership. And the market, it seems, priced in an expectation very quickly.
It did. The core idea was that American companies might get broader access to Venezuela's oil reserves.
That possibility alone was enough to move stocks.
Oh, absolutely. The response was almost immediate. You saw some stocks rally and others take a hit based just on that potential.
So for our conversation today, we're going to follow that money. We'll look at the three groups of companies that the market seemed to view with optimism, and then on the flip side, the three groups that felt some pressure.
Right. And it's about getting past the simple idea of just more oil. It's about, the specific type of oil, the infrastructure needs, and even old financial claims. That's what really drove the trading.
So let's start there. When the news broke, what was the first reaction in the energy sector?
Well, U.S. energy stocks reacted fast, but it was targeted. Chevron, for example, saw a notable rally.
Why them specifically?
Because they're already there, they're operating under some limited licenses, which puts them at the front of the line to benefit from any easing of restrictions.
Yeah, okay, that makes sense. But let's back up a little. Why does access to Venezuelan oil matter so much to the market right now? It's not just a few more barrels in the global pool, is it?
No, not at all. The reaction really comes down to three specific dynamics that create a path to profitability for certain kinds of companies.
And the first one is?
The first is what we can call the heavy crude advantage. The thing to remember is that Venezuela's oil is mostly heavy, sour crude.
And that's important because?
Because for years, the big U.S. refineries, especially in the Gulf Coast, were built specifically to process that exact type of crude oil. When that supply was cut off, they had to find it elsewhere, often from further away or at a higher cost.
I think most people assume that lighter oil is better. Why would a refiner actually want heavy crude?
That's a really common point of confusion. Light, sweet crude is easier to process, sure, but it's usually more expensive. Heavy, sour crude, it's thick, has a lot of sulfur, it's cheaper to buy.
Okay.
So these complex refineries on the Gulf Coast, they have all this specialized gear coking units, hydrocrackers, that can take that cheap, heavy stuff and turn it into high-value products like gasoline and diesel.
So if they can get a steady, cheaper supply of heavy crude from nearby Venezuela, the difference between their input cost and their selling price, that refining margin gets wider.
It gets wider. That's pure profit leverage right there. And that potential for margin expansion is why certain refiners were instant winners in this scenario.
Okay, so that's the heavy crude angle. What was the second dynamic?
The second is the sheer scale of the capital expenditure opportunity. I mean, after years of political instability and, frankly, a lack of investment, Venezuela's oil infrastructure is in a state of disrepair.
We're talking everything from wells to pipelines.
Everything.
Yep.
Wellheads, pipelines, storage terminals, you name it. If U.S. investment is allowed back in, you're looking at a multi-year, multi-billion-dollar rebuilding program.
Which sounds like a guaranteed pipeline of work for a certain kind of company.
It does. It creates a very strong demand forecast for the big oil field service companies. This isn't a one-quarter job. You're talking about new drilling, complex maintenance, remediation work that's measured in years. And markets love that kind of long-term visibility.
And the third factor?
The third is asset recovery. Many of the big U.S. majors have historical claims against Venezuela for assets that were seized years ago. Some of them even hold large arbitration awards that they've never been able to collect.
So this isn't just about making new money. It's also about getting old money back.
Exactly. A more U.S.-friendly government could mean a clearer path to monetizing those claims, or maybe even regaining control of the assets themselves. That possibility, even if the cash isn't coming tomorrow, gives an immediate boost to their stock valuation.
Okay, so we've got the heavy crude leverage, the promise of a massive infrastructure spend, and this asset recovery option. Let's name some names. Which companies saw the immediate benefit, starting with those refiners?
The first group, no question, was the U.S. refiners, the heavy crude optimizers. They are the most direct beneficiaries of that heavy crude flowing back into the Gulf Coast. Their entire business model gets a boost from cheaper feedstock.
So which companies really stood out?
You'd want to look at names like Valero, that's ticker VLO, Marathon Petroleum, MPC, and PBF Energy, PBF. These are the players with the complex facilities that can really squeeze the most profit out of that kind of crude.
And moving on to that infrastructure rebuild, that sounds like a major opportunity for the big service companies.
It is. The oilfield services and equipment sector lit up. Their business is all about capital spending. And the prospect of a multi-year redevelopment in a country with proven reserves is a powerful growth story for them.
And I'm guessing this favors the big global players who have the scale for a project like that.
Yes, exactly. The large international service providers are the ones best positioned. We saw immediate interest in SLB, which is the new ticker for Schlumberger, Halliburton, HAL, and Baker Hughes, BKR. They're built for these kinds of large-scale international projects.
And that third group of winners, that
Like-
ties back to the asset recovery in their existing footprint.
That would be the U.S. majors. Chevron, ticker CVX, is in a class of its own here because of its existing waiver. Any easing of rules lets them expand immediately. But you also saw a bump for others with historical claims, like ExxonMobil, XOM, and ConocoPhillips, COP.
For them, it's about the increased odds of getting something back on those old claims.
Right. A better chance of recovering assets or getting a cash payout for those awards they've been holding.
So a clear picture on the upside. Refiners, service companies, and majors. Now let's look at the other side of the coin. If this much potential supply could come online, who gets nervous?
The pressure showed up in places that are sensitive to the global supply story and to domestic U.S. spending plans. The first group to feel that pressure was the U.S. shale-heavy exploration and production companies, the E&Ps. These are the producers focused on places like the Permian Basin in Texas.
Why are they worried about new international supply?
Because their bottom line is incredibly sensitive to the price of crude oil. Any credible story about bringing Venezuelan supply back, even if it takes a while, adds to this global feeling of plenty of supply.
And that psychology tends to put a lid on oil prices.
It does. It limits the potential ceiling for crude. And if prices are capped, the valuations of these E&Ps can suffer.
So which are some of the key names that felt that pressure?
You saw some selling in names like Devon Energy, DVN, Diamondback Energy, FANG, EOG Resources, EOG, and also Occidental, OXY. These are producers whose fortunes are really tied to the U.S. domestic price.
And if the E&Ps are getting cautious about their own spending because of capped prices, that has to trickle down to the companies that service them here at home.
It absolutely does. And that brings us to the second group under pressure, the U.S. onshore drillers and the shale-focused service companies.
So there's a split in the service sector.
A clear split. While the big international guys like SLB and Halliburton get a boost from the Venezuela story, the domestic service companies depend entirely on the spending budgets of those U.S. shale producers.
So if the E&Ps pull back,
If they get cautious, then demand for U.S. onshore drilling rigs, for fracking crews, for all the localized services, it weakens. So you get this divergence where the international outlook improves, but the domestic one softens.
Can you give us a few examples of those domestic-focused names?
Sure. Companies like Helmerich and Payne, HP, Patterson-UTI Energy, PTEN, and Liberty Energy, LBRT, they felt that negative sentiment almost right away.
Now, this final group is maybe the most removed from the oil patch itself. Electric vehicle makers. Why would a barrel of Venezuelan oil affect a company like Tesla?
This is all about sentiment and consumer psychology. The market starts pricing in a long-term view that more global oil supply eventually leads to lower prices at the pump.
Cheaper gasoline.
Cheaper gasoline. And what does that do to the consumer?
It probably reduces the urgency to switch to an EV.
Exactly. It just softens the immediate economic argument. A big part of the appeal of an EV is saving money on fuel, and that appeal is strongest when gas prices are high. If traders start to believe in cheaper gas for the long haul, it takes some of the wind out of the sails for a consumer thinking about making that switch right now.
So it's not about the long-term viability of EVs, but more of a near-term headwind against the adoption rate.
Precisely. It's a narrative trade. And you saw companies like Tesla, TSLA, Rivian, RIVN, and the charging company ChargePoint, CHPT, all feel a bit of a downdraft from that change in sentiment.
This all lays out the immediate reactions pretty clearly. But, of course, this is all based on expectation. We all know getting that production back online is a huge undertaking. So what should people be watching for to see if these expectations turn into reality?
I think there are three key things to monitor. First and foremost, you have to move from political talk to legal reality. Watch the specific sanctions and waivers.
So the actual paperwork.
The actual paperwork from the U.S. Treasury Department. Until those licenses and rules are officially changed, everyone is just operating on possibility, not certainty. Political statements are one thing, legal authorization is another.
Good point. What's the second thing?
The second is a realistic sense of timing. Even with new licenses, a production rebuild on this scale is a massive industrial project. You're talking about clearing debt, repairing pipelines, shipping in equipment.
It's not flipping a switch.
Not at all. This is a process measured in years, not weeks, before you see meaningful new barrels on the market. So the service companies, for example, are looking at a multi-year horizon, not an immediate boost to their next quarterly earnings.
And the third factor to watch.
For the refiners, the third factor is all about the spread trade. Once the oil actually starts to flow, their success will depend entirely on the price difference between that heavy Venezuelan crude and lighter types of crude.
You mentioned refining cracks earlier. Can you just break that down for us?
Sure. Think of the crack as just the refiner's profit margin. It's the difference between what they pay for the raw material, the barrel of crude, and what they get for the finished products, like gasoline.
So they need the crude to stay cheap relative to the price of gasoline.
Exactly. They win only if that spread stays wide. If a flood of heavy crude comes online and it narrows the price gap between heavy and light oil too much, that whole profit advantage could shrink or even disappear.
So their long-term gain isn't guaranteed just by access. It's conditional on the market structure.
It is. They need the access, but they also need the right price dynamics for that heavy crude advantage to really work for them.
This has been a really clear breakdown. We've tracked how a single political headline created these immediate camps of winners and losers, from refiners and service giants on one side to domestic shale producers and even EV companies on the other.
It's a great example of how these global supply narratives can really direct capital, separating companies' positioned for international work from those more sensitive to domestic prices.
And I think it leaves us with a final thought to consider. The market reacted instantly to the possibility of access. But the real question is whether the crude market itself can actually absorb that new supply, if and when it arrives, without eroding the very profit margins that made the winners look so attractive in the first place. Thank you for joining us on Breaking News to Trading Moves. And our reminder, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.